Hi, welcome back to our lecture on the practical guide to quantitative finance interviews. Today, we are going to talk about the common financial measures and tools, basically a wrap up and trying to complete our whole chapter about the financial derivatives and structuralized tool. Okay, so it is also going to be our second last lecture. So let's first begin with the portfolio optimization. Portfolio optimization is like a very common topic that if you go to a business school course, it's like the very first few things you are going to learn on the courses in the courses. And let's discuss about that. And if you already learned about that, it's trying to help you review using this classic question. So you are constructing a simple portfolio using two scores, A and B. Both have the same expected return of 12%. The standard deviation of A's return is around 20%, and the standard deviation of B's return is 30% instead. The correlation of their returns is 50, 0.5. And how will you allocate your investment between these two stocks to minimize the risk of your portfolio? So first, before solving this specific question, let's have a review of the most classic and the most well-known Harry Markowitz's mean and variance portfolio. So it argues that there is a portfolio that the risk is already minimized. If we within this portfolio, we have, let's say, n assets, and each of them has the mean of mu n and the variance, which is sigma square n. And then the portfolio's mean is going to be like that, which is just the weighted sum of all the different assets. And for the variance, it's also just the weighted sum of the variance item plus their correlations. And for this larger sigma here, it's basically the covariance matrix where we have sigma 1, sigma 2, sigma 1, 2, sigma 2, 1. This is 1, 1, 2, 2, and all the way goes to NN. And on the diagonal, we basically have the variance. And for all other items, it's basically the correlation between any two assets. Okay? And we are just trying to minimize the variance, which is this item here, such that there are two conditions we need to maintain. One is that the mean is still the same, and also all the weights sum up together should be equal to 1. Okay, and the E here is just a denotion of a common one factor. Okay, so let's try to solve the original question. We have like the mu A, which is, and also have mu B. Mu A is equal to 12, equal to mu B, and the sigma A, the standard deviation, is actually 0.2, 20%, and the standard deviation of B is 0.3. Right, let me check if it is correct. Okay, it is correct. And the correlation is 0.5. So we have WA plus WB equal to 1. So WB is just 1 minus WA, right? And the original variance of this portfolio is just sigma A square multiplied by weighted A square plus the sigma B square. Let's replace WB by 1 minus WA to the power of 2 plus 2 multiplied by rho multiplied by sigma A, sigma B, WA 1 minus WA. It's often seen students that trying to mixing these two weights here. Be remember to add that. Basically, they occurs in pairs. Okay, once you have a standard deviation item, you are going to have a weight item. So let's take the derivative of this variance P according to weight A, because we are trying to find the best way to allocate our asset, right? So it's the weight that we need to find to help us to minimize the risk. And by taking the derivative, we can have 2 sigma A squared WA, and here will become the minus minus 2 sigma B square 1 minus WA and plus 2 rho sigma A sigma B, right? And this is just 1 minus 2 WA. And if we're trying to remove the several items, then we can find that WA is actually, and we let this equation equal to 0 so that we can have WA is simply going to be sigma B squared minus rho multiplied by sigma A sigma B, and sigma A squared minus 2 rho AB, right? This is rho AB, okay. Sigma A sigma B plus sigma B squared. And the final answer will be 6/7, okay? So this is the answer for this specific question. But if you really want to learn more, actually there is a closed form for the optimal weights. Okay, let's try to write it here. Let's add one more page. So we need to first define a few things. If we define a large A as E sigma inverse E, okay, the E is just the vector, then multiplied by one vector with all elements equal to 1, okay? And we define, and this should be larger than 0, and we also have B, which is E mu sigma, large sigma, and also mu, and C is going to be, all these are larger than 0, okay? Mu, larger sigma, mu again, larger than 0. And we define D equal to AC minus B squared. You see B is the only, B is like the intermediate. And then we are going to argue that the best weight, which is n multiplied by 1 matrix, okay, this kind of matrix, is going to be lambda sigma E plus gamma sigma net inverse mu, where lambda is going to be C minus mu P B D, where mu is the mean of the portfolio, And we also have the gamma, which is, again, mu PA minus B over D. So I'm not going to prove it here. It's going through some complex calculation, but it's not that hard. It just takes some time, some high school level things, okay. So if you are interested, you can remember that. But still, in reality, I still hope you just solve it from scratch. You know, this formula is too complex to remember if you do not have a formula sheet or cheat sheet. But if you have it, or you have a matrix calculation, of course, it's the fastest way to do that. But for human beings, we are not good at solving a larger matrix by hand, right? It's good for computer algorithms. Okay, so now let's come to the second important concept, which is value at risk. So briefly explain what VAR is and what is the potential drawback of using VAR to measure the risk of derivatives. So VAR and stress test, or more generally, it's just a scenario analysis, actually an important aspect of risk management. And basically, it's defined as the maximum loss over a target horizon a time period, such that there is a low enough pre-specified probability, which has a low enough probability that actual loss will be larger. And if you are a statistician, you have taken some basic statistical course, how do we interpret this into mathematical language? Well, you must have linked this concept with confidence interval, right? So let's write it in mathematical language. Given a confidence interval, which usually is 95%, right? So this VAR is simply what? Alpha equal to negative VAR to the positive infinity x fx dx, where this x is just the P and L, the profit and loss, and fx is the PDF. And you can see now VAR is just that. VAR is just the fifth percentile of the profit distribution, right? And what is good and also bad for percentile is that it is independent. It is independent with the tail shape. What does it mean? What does it mean? It means that, okay, if we have a normal distribution, let's say it's a normal distribution, right? And basically we can have our fifth percentile here. Okay. And then if this value, let's call it some kind of, if I define this as 0 and let's say this is something like negative 0.3, then no matter how this part looks like, it can look like it's really heavy, or it could just closed here, right? Or it could like doing things like that. It's in extreme cases, of course it can, but no matter how the shape of the tail looks like, the fifth percentile is also the same number, which brings the significant drawback of VAR, that VAR is not subadditive, which means in our classic portfolio theory, we always want, if C is combined of A plus B, then there must be a way that VAR-C should be smaller or equal to VAR-A plus VAR-B without any asset or weighted allocation. But this argument actually does not stand, okay? It does not stand for VAR. A common example is that if you are buying a bond and you add a long position about the bond, okay? And if you add a short position in a credit default swap bond with the same amount of value, let's say A and B both have a same default rate of 3%, then 3% is smaller than 50%, right? So VAR-A is going to be 0, while VAR-B is also 0, right? If you just buy them independently. But when they form the portfolio C, that at least one of them default becomes what? It becomes this one, which is 1 minus 3% multiplied by another 1 minus 3%, right? And this is going to give you around 5.9, which gives a non-zero VAR and makes this inequality breaks. Okay, so it's like a theoretical drawback of VAR. And actually, this sub-additivity is like one important property of a coherent risk measure. It should be coherent if a measure is called coherent if this stands, and we have some other kind of probability. If you're interested, you go check on that. Okay. So another important, the third important concept is duration and convexity. It measures the property of a bond. So a duration of a bond is defined as D equal to negative 1 over P multiplied by the derivative of P over Y. And P is the price of the bond and Y is the yield to maturity, which are two most important things for a bond. Actually, it's a little bit similar with option, where you have the stop price and the strike price, and those two are like the things define everything. And you also have the convexity, it's basically the second derivative, and you remove the negative sign before this formula. And by Taylor's expansion, you can have this this approximation here. How can we have that? Let me derive it for you. It's quite easy. So we know for Taylor expansion, fx is going to be fa plus the first derivative, right? Multiplied by x minus a over 1's factorial, to be specific, and the second derivative of x over x minus a squared over the second derivative, right? And if we put in that, if we remove this one, like fx minus fa is gonna to be what? The first derivative is dp dy, right? And this is going to be x minus a plus 1 over 2 multiplied by d square p d square y, okay? And this is, again, x minus a squared. So replacing all the items, this, and this suddenly becomes dp, and this is dy, and this is dy squared. And now it all gets familiar, right? We just need to divide the left-hand side part and the right-hand side part with p at the same time. And for this and this, we form c. And this part is negative d. And we have the equation here. Okay, quite easy, huh? And what you need to remember is that with more maturity, the D is going to be higher, which means it is going to be more volatility. And with more yield, of course, it is going to decrease. And also, if there is a larger C, well, C is just the coupon rate. Okay, C is the coupon rate. Let's see here. And it is fixed. And for convexity, it's also the same, that the increase in yield and the coupon rate is going to decrease the convexity and the derivation at the same time. And another important concept is that, okay, so first about that, it is actually also quite simple. With more time to maturity, then there is more uncertainty about the future because you have a longer time to wait, right? We are uncertain about the future. So the volatility is going to be high, which means the changing rate is going to be higher. And with more coupon rate or more yield, it means that it pays better, right? And as long as it pays better, so for every amount of change in that yield, the amount of price change is going to be smaller, okay? Because it is actually more stable and more robust. You can think in another way. If I have a larger yield or higher coupon rate, it simply means we are trying to zip, we are trying to compress coupon with longer pay terms to a shorter terms. For example, if we have a coupon A which pays me $10 for 10 years, 10 for 10 years, and basically we can construct with a higher yield rate, we can approximate it with somehow like something 20, I don't know, or even 80 for 5 years, right? If the interest rate equal to 0, okay, if we don't need to consider the present value of the of money, okay. So the commonly used concept is this dv01 here, where dv01 is just dp dy divided by 100. Why it is 100? Because usually the bond has a face value, right? We have a face value of 100, so we divided that of that. And then we also need to measure when the yield changes by 1 basis point, but instead of 1, okay? So we need to further divide it by another 100, okay? So now let's see a real question. Before the real question, I want to remind you of the non-arbitrage theory or the non-arbitrage argument, where if we have exotic security or even you have exotic bond, the price of it should be the same of the replicated portfolio as long as we can find a good way to replicate any payoff term of that. For every payoff term of that, if we could replicate that, then the price should be the same. And also the dollar derivation of these two things should also be the same. So our logic to solve this kind of question is simply trying to replace the original strange item, the strange security, the exotic one, with a combination of something we get used to about. Okay. So now we are being asked to give the price and duration of an inverse floater with face value 100 and annual coupon rate 30% minus 3R. And this R here is just the we'll call it, we can call it flexing. Floating rate bond. We know there is a thing called limbo, right? The base rate for banks are actually changing over time. So this is basically the R defined here. And also assume that the coupon are paid semi-annually and the current yield curve is flat at 0.5%. So our way is basically to have this duration, okay, with some kind of A multiplied by something B fixed, right? Minus another B part of D floating. Okay. So we have the parameter -3, right? So basically we can start from B equal to 3. And then for B of 3, we are basically like short 3 floating bond, where at time 0, t equal to 0, we are going to have $300 plus, right? Because we are shorting it. And at time equal to 0.5, we are going to have what? We are going to have negative 150, since the face value is 100 R, and all the way goes to what? Goes to t equal to 5, well, we are going to have another negative 100 R minus 300 because we are shorting. And to match this thing with the original coupon, we need to learn how much of fixed bond. Remember, our current yield curve is 7.5%. So we basically define the coupon rate as also 7.5%. And to originally, we are going to buy this thing, which is 100. So we need to learn 4 pieces of that. So that at time t, we are going to have negative 400, which is also negative 100 in total, the same with the original thing. And at 0.5, we are going to have 400 multiplied by 0.075, which is exactly 15. And we also need to divide it by 2 because it's semi-annually. So which is exactly 15 minus 150 R. And matches this item here. And for t equals to 5, it's 400 plus 50. Again, it matches. So basically, we solve this question by these two things, and then we just need to calculate the duration of these two items one by one, and then break it up. Okay. So for this floating item, this is going to be negative d dy. And what is dp? The dp is just the face value, since the yield curve is flat. So the floating rate bond is going to be what after 5 years? It is going to be 103.75 because it is flat. Okay, it is flat. So we basically only need to use 5 multiplied by 0.5% plus 100 to get the value at the end of the 5 year. And we are going to divide it by 1 plus y divided by 2. Okay, and y is just y equal to 75. And basically by getting that, we are going to have something with 48.19. Why is that the case? Because we can use the formula here where we can convert this thing dp dy into a negative d multiplied by p. Okay. So the dy, we can define it as 0.5 because it is fixed term. So every every half of the year, we change the part. So this value is actually derived from, we have 0.5 and divided by this 1/372 and 1 plus y/2, 2. Okay. Because this dy here is just 1 plus y/2 divided by 0.5. And how about the fixed rate bond? For a fixed rate bond, please remind of your university level knowledge, which is just if because it's semi-annual, so we have 2t, where t equal to 1. And it is going to be c divided by 2, which is the coupon rate divided by 2 of 1 plus y over 2t, right? And plus the face value payment, which is 100 over 1 plus y divided by 2, 2t. And again, we divided it by dp over dy, which put all these things multiplied by 1 over 1 plus y over 2. And it brings us back to the value of 410.64, okay? And then you just need to multiply this 1 by 3 and divide it by 4. And you can get, multiply this by 4 and divide it by 3, and you can get the final answer. And the last concept here is forward and futures. So forward and futures is mainly about we need to know the difference between them. So they are both something targeting certain goods, right? It's like the foundation of the options, but you need to know the first thing is that the forward contract is OTC, okay, which means you can sign it, you can just build up a forward with anyone who is willing to trade with you. But for futures, there is a clearance house, which is usually exchange. The largest one is what? Is Chicago CME, right? The classic one, which you can find actually the best prop trading house are usually located in Chicago. Like over 50% of them are not in somewhere like New York, London, or Hong Kong, but they are in Chicago because it's the best place to trade future and options. And it's the main battle for quantitative traders. Okay, over 70% of the total trading volume ever in this world comes from there, and they are all contributed by quant funds. Okay, it's time for quant. Well, and the second thing, although the term is long, is that it's just the future is not the forward is not standardized. You can customize any items or lines you want, but in future it's usually standardized in terms of quantity, quality, and delivery date. And if you really trade by yourself or see the real market, you can see it actually fix the margin, which is the amount of money you need to put into the bank. And like I mentioned here, like you need to put some initial deposit into the trading account, which we call the initial margin. In China, it is really 8 to 10%. Okay, but for forward, that's not the real requirement. Okay, as long as you have someone trade with you, because it's OTC. It's just like you trade something on Xianyu. Okay, as long as you find someone who is willing to buy that, it's okay. And another thing is that forward is usually only have one specified day, but for future, it can be delivered in a few days. Like you can first have the first delivery day, you can have the last day, a lot of items. It is really complex, but for traders, usually that's not of a lot of importance because we do not want any delivery, right? You know, there are some news from time to time that some bad luck traders actually got the items. For example, he has like 10,000 hands of Apple contract, and then it is delivered. So like enjoy 1 year of Apple meals. Okay, so last one is that it's not formula regulated. It's just like my mentioned, but the future is regulated by the stock exchange or the future exchange in Chicago. Another concept I want to tap on is interest rate models, but this is quite advanced. And usually it is never going to be asked during interview unless you are interviewing some companies specialized in fixed income, for example, like PIMCO or a few others. I'm not an expert on that, so I just want to tell you that there are mainly two kinds of models. One is called arbitrage free, another is called equilibrium. And the normal formal model is just the same like the one we use for options. We did return as some kind of, having some kind of drift item with regarding to the short time T plus the volatility item with the Brownian motion. And the main problem is that related with these two parts, you have different kinds of models. You have the setting, you have cosine growth, you have wholly or different kind of things. So this can be either theta t or some like constant sigma. It can be also sigma t. It can be like sigma multiplied by some kind of reshaped item. It's all subjective to the definition of each kind of model, but the format is still the same. I hope you just want you to understand that we are basically trying to use in the same way, applying Ito's lemma and this kind of stochastic derivatives to solve out the price of this asset. It's still the same, but the difference is just like seeing the drift item and the volatility item. Okay, so I think that's all for today's lecture and also for the finance chapter. I hope you enjoy and I hope I give you a clear concept all the way since Ito's lemma and the stochastic equation to different concepts of financial tools. You have a basic walkthrough of the whole financial market now. And last time is going to be our last lecture. We're going to go through the coding parts of the green book. But I know most of you is going to train your coding abilities on lead code. And of course, that's like the right thing to do for interviews. So for that chapter, we just need to go through that very quickly and to wrap up the whole book. So thank you for following me and watching until now. Thank you.